Hey guys, welcome to Tickzon Mentorship Scheme, where we try to turn our hindsight into your foresight. Now, if you're not subscribed, you're missing out because this is stuff that school ain't teaching you. So, today we're going to do a little intro into investing. I'm just going to explain what investing is, what stocks are, what ETF index funds, and what commission, non-commission tradings are, etc. So obviously, if you clicked on this because you saw what returns I was getting using the Trading 212 app, firstly, when it comes to investing, your money is at risk, but ultimately they say no risk and no reward. So firstly, what is investing? Obviously, investing is putting your money to try and make your money make more money, and ultimately in doing that you can lose money. So the one we're going to be talking about today is about investing in stock, investing in the stock market, and then you can invest in it in different ways. Today I'm going to be talking about stocks, index funds, and ETFs, what they are. In terms of individual stocks or shares, that basically means that you own a part or percentage of a company. For example, you can go and buy Google, you can go and buy, or Alphabet, you can go and buy a piece of Tesla, which, for £200, the company is worth, let's say, £1 billion, but for £200 you could own one part of that billion, or a share of X amount of shares. So it could be one share of 1 million shares available, one share of 100 shares available, and based on that and based on the value of the company, the share price will go up or down, which means that if the company becomes more valuable, then your stock or your share becomes more valuable, and then the more stocks you own, the more stake you have in that company. So if that company does well, then you do well. Now, those are just individual stocks. Now there's something called ETFs or index funds, which is electronic traded funds, ETFs or index funds. This is basically like a collection of instead of you having the ownership of one company, which is one stock, which, let's say, I could buy into a company, for example, like an Alphabet, maybe for £150. Instead of having one company you invested in, let's say you go into the S&P 500 or the FTSE 100 or 500, and I can own a piece of 100 different companies, or a piece of 500 different companies, or a piece of 50 different companies for the same price. So my £100 would be basically, I would own a little bit. My £100, I'll own a little bit of all these different companies in the top 100. So the FTSE 100 is the top 100 companies in the UK stock market, while the S&P 500 or S&P 100 or S&P 50 is the biggest 50, 100, 500 for the US stock market. So an index fund is a good way to diversify and have your money in different pots. And obviously with the S&P 500 or 100 or 50, same with the FTSE, 200, whatever, it's the 100 most profitable companies that are tracked in there, and basically you get an average of how well all of them are doing. Then if a company is no longer doing well, they're dropped out of the S&P 500 and the next company is now fixed in there. So you can pick individual stocks, or you can go to index funds or ETF trading, which is just essentially you have Vanguard, Fidelity, SPDR, all these different kind of ones that track different commodities. There's international stocks, there's local stocks, there's national stock, there's different types of stocks. So obviously do your research into the company. You want to know, you just want to know. If you want to do your research into a company, or whether the value of that stock is actually worth what the company is. So obviously I showed you what my returns have been. Ultimately it does go up and down, so as of recording this it has gone down a little bit. I do not really unless it's like a one-on-one conversation, I don't really share what I'm investing in, because I'm not trying to tell you what to invest in. You kind of need to go with yourself. I'm not a financial advisor, I'm not an expert in this. To be honest, to some extent, I'm not gonna lie, I'm just lucky in some of them. I do have index funds, I do have individual stocks. There are a bit of variety in what I've got, but ultimately do your research. It's up to you to kind of go with it. If anybody's telling you that they can tell you what's going to happen in the market tomorrow, they're lying, because nobody knows. And if they actually have actual information, it's illegal, because that's insider trading. What you need to understand about the stock market is, one, the stock market is emotional. Like, it is very emotional. It doesn't make sense. So it's one of those ones you can't really calculate or time what is going to affect the stock market. So for example, you know, Brexit, they announced Brexit today, the stock market can go down. That doesn't change the value of any of these companies, you know. But, you know, just announcing Brexit last year made the pound go down or made the stock market go down. You know, now the coronavirus, the virus is going on. You know, prices are going up and down. Little things affect it. If, you know, if the CEO of, like, when, for example, when Elon Musk was making his statements were affecting the stock price of Tesla. You know, a new product can make it go up. That, you know, Google, Amazon buying a new company can make their value go up or go down. You know, so events happening in the world. You know, is Germany in a recession? Is Japan in a recession? That can affect each other. So if America was to go into a recession, that probably affect the UK. Would that affect our market? You know, different things. It's like, okay, is there a hurricane happening in a country in South America? Now, let's, for example, does that country trade a lot with the UK? So that hurricane could mean people won't want to buy any of those things that they're serving for the UK. So that means the stock market go up. What am I trying to say? I'm trying to say is that the stock market, anything can affect the stock market. It can go up today, it can go down tomorrow. In the last few weeks, it's gone. You can't time it. So anyone that tells you that they're expert in the stock market, they don't know jack. Now, there's essentially two types of markets. There are two types of periods you can normally be in when it comes to the stock market, which is a bear market and a bull market. And that's basically, for example, bull market is when the values of stocks are going on the roof and we're getting high returns and all companies are going up and up and the values are going high, which is what we've been in for a very long time. Or we could have a bear market where, you know, values crush down and, you know, it's you know, basically recession time. It's a bear market. You know, stock trading is the activity in the stock market has gone down. Values of companies have plummeted. Some go into bankruptcy. Activity in the economy normally slows down during that time. Normally, unemployment rises or underemployment rises, which is basically when you're employed but not paid enough to live. So that kind of thing happens when it's in a bear market. So when it comes to the stock market, you want to be kind of generally aware what's happening in the world. Like, you can't just time it by what's happening in the UK market to say what will happen in the UK stock market. For example, let's say, you know, a company creating one type of battery is now slowing down, which means that Apple can't make their products, which kind of means that people aren't going to be doing Apple products and blah, blah, blah. And that affects Apple, and then all Apple's investment goes down, and it's a trickle effect. That's the reason why it's always like a bubble. Is stock markets a good thing to invest in? Generally, yes, it's something good to invest in, but obviously be smart. If you look at the way things are going now, in the next couple of years, we probably will be in a recession. So I would advise you that if you're going to invest in the stock market, don't invest all your money in the stock market. Make sure that you have savings, to help you out. Because, you know, if you put £100 there tomorrow, yes, it might be 200, but tomorrow, the next day, it could be £20. And ultimately, in terms of investing, depending on what kind of risk tolerance you have, will depend on what kind of investor you would be. Me, I'm just doing kind of like £50, £100 every month, consistently putting it into the market, regardless if it goes up and down, because I don't mind losing that amount of money per month. You know, that you do the strategy that you want to do. Alternatively to investing in the stock market, there's other stuff like Moneybox, Wealthify. There's so many different investing platforms. Obviously, do your research in all of them and how they actually work before you actually put your money in there, because past returns do not indicate future returns or future performance. Just because somebody says, oh, I got 10%, 15%, 9% in the past does not mean you're going to get it. So, you know, bear that in mind. Lastly, one other thing I'm going to talk about is something called fractional shares. So for example, some of these stocks, to buy into them, they're very expensive. You have stocks that are £1,000 to buy into them. So if you go into these platforms, if you go, you know, if they allow fractional shares, then you can buy 1/1000th of one share. So instead of coming in, let's say for example, instead of coming in at Tesla at £200, you can come at Tesla at £20. But it means you would own 1% 1,000th or 1/100th of one share. So that's how your percentage of stake in the company. But even though it's just that small amount in terms of number of shares, even though it's 1/1,000, if it's £20 and the company goes up by 10%, your £20 will still get a 10% return. You understand what I mean? So your £20 will become £22. So you still make money regardless. It just means that you can't say I have one share, it's got I've got 1/1,000th of a share. So that's what fractional shares are. Not all platforms allow it. Trading 212 does allow it. I'm not sponsored by Trading 212, but Trading 212 is one of the commission-free trading apps. So why is commission-free trading apps good? Because normally back in the day, or even still now, if you were trading through like a bank, they would charge you a commission fee for every trade you made in terms of buying a stock and selling a stock. And so, for example, if you wanted to buy a stock which was £10, you still have to pay £12 on top to buy that one stock. So that is £22 just to buy that stock when your stock is only worth £10. Then let's say if your stock went up to £15, so you wanted to sell because you wanted to make a £5 profit, then you still have to pay the £12 on top. So you only actually really took out £3. So that's the reason why in the past it was really hard for anybody to invest, because it was so much. You really had to be buying a lot of shares for it to make sense for you to actually buy stocks. But now if you use a commission-free trading app similar to Trading 212, there's also Plus 500, there's also other ones out there, eToro, all these kind of things, that if you use those apps you can buy in commission-free. Secondly, if you're in the UK and you are trading and you're buying stocks, my advice to you is to use a stocks and shares ISA. So, which is, you can get, most of these trading apps will allow you to have a stocks shares ISA. I know Moneybox and I know Trading 212 because I'm using a stocks and shares ISA in Trading 212. But it means that you will not pay tax on your capital gains. So basically, if you put in £10 and then your £10 turn into £15, when you sell it, they will tax you or charge you on that £5, and then you'd pay that to the government. Whereas if you do in a stocks and shares ISA, that £10 you put in there, when you take out that £15, you don't pay any tax. And if you use a no commission app, then you pay no tax and no commission. So that means everything you get in there is basically free. Any money you make or any money you lose is free. Obviously there's an ISA allowance of 20k in your stocks and shares ISA, depending on how much you use in your other ISA accounts. So just letting you know, that would probably be your best option, to use a commission-free app as well as a tax-free account, which is an ISA. Ultimately, if you're doing bigger stuff or you want people to cash manage it and stuff like that, alternatives are using the bank, using investment banks, using Wealthify, which you just use, like basically drip in your money one by one per month, and they will do it for you. And yeah, ultimately guys, trading is a risky business, but still something you should definitely do, because for example, if you've just been investing £10 a month or £10 a year over the last 5 years, your money probably would have doubled by now. It's just little stuff like that. Ultimately, your investment is at risk, so do research into whatever you're going to invest in, but you are never too young to invest. And with some shares I've bought, you can buy shares with £1, so there's no excuse. There's no excuse. If I started doing it by, if I bought a lottery ticket, I'd buy 5 times worth of shares of a lottery ticket, and then I've stopped buying lottery tickets. That was like a couple of years ago. So you just do this kind of stuff and your money start making money, and then as you can see in the thumbnail, returns. So yeah guys, have a lovely day. Thank you for rocking with us. Subscribe, drop in the comments if you have any questions or anything, and we'll explain how to use the app in another video. But yeah, this is just like an intro into investing. Bada boom.